Oh, good morning, hello, and good morning. It's me, once again, Kenny Polkar, your host of the party, and today is Wednesday, October 5th, 2022. And what is it that you need to know, right? The markets had another up day yesterday, right? So it's this two-day monster rally. This can't possibly go on that way. OPEC and OPEC Plus is meeting today in Vienna, Austria, and production cuts are on the table. Energy is up more than 7% in the last 2 days. Earnings are now only a week away. Financials are the first ones to report, and rumor has it that they're not going to disappoint because they've brought their estimates down. So naturally, they're going to jump right over that bar and everyone's going to beat. Futures are pointing to some profit taking today. And what do we have for dinner tonight? Well, we're going to have Fantasia Shrimp Scampi. And Fantasia's was a restaurant that my parents used to go to where I lived, where I grew up in Belmont, Massachusetts, but we'll talk about that. So it's boom, boom, bang, right? Stocks continued their run higher as the shorts ran for cover because the idea that the Fed may pivot, which is not an idea I support at all, caused the algos go into overdrive. And the overdrive caused those same algos to cancel the sell-side interest, leaving a void in prices that forced the buyers to pay up and up more than 6% in the last 2 days. And some stocks are up even more. And we're not even talking about the sexy names. We're just talking about some of the stalwarts. JP Morgan up 8%, Johnson up 8%, Amazon up 9%. BTU up 15%, Comstock up 22%, ExxonMobil 8.5%, Goldman 8%, Boeing 9%, Microsoft 7.5%, Home Depot up 7%, and Nvidia's up 9%, and Apple up 6%. By the time the bell rang yesterday afternoon, we saw even more gains. The Dow up 825 points, or nearly 3%. The S&P up 113, 3%. The Nasdaq up 360, 3.3%. The Russell's up 67, or 4%. The transports added 455 points, or 3.6%. So now we've had these 2 days of significant moves up, and everyone's celebrating. And I say, not so fast. The reality is that there are a number of factors at play. First, we were in a well oversold position. The month of September weakening as the days passed, and when it became obvious it wasn't going to get any better before the month ended, portfolio managers and investors chose to bail. Losses, creating more losses, margin calls, forcing investors to sell stocks or any other asset they could in order to meet the call. Professional traders building bigger and bigger short positions to take advantage of the weakness only meant that at some point that trade would have to be reversed. So in a way, the big short positions translate into a bullish signal. And why? Because all of those short sellers need to become buyers when they have to cover their position. And so we'll prove that in a moment. Then we had not one or two Fed heads being aggressive, but we had every one of them singing the same tune: inflation, 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 and the need for the Fed to tackle and tame it before it becomes truly entrenched in the economy. 75 basis points is the chorus, and you could hear every one of them singing it after JJ promised as much in the September FOMC meeting. Remember, there were more than 20 Fed speeches last week, and every single one of them was aggressive, 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 right? That was the end of September. Third was the economic data that's been mixed at best, with some data points suggesting a weakening economy, other data points not responding to the heat of rising rates, causing JJ and the Fed to raise the terminal rate, or what is known as the neutral rate, which had been somewhere between 4 and 4.25%, to more than 4.6%. And Jimmy Bullard, St. Louis Fed president, even hinting that the terminal rate could have a 5 handle on it during the final week of September, which only added to stocks in its tailspin, right? And it caused portfolio managers to dump the losers, of which there are many, as they prepped for the start of the final quarter of the year. The thinking being that just clean it up, right? Take the hit to the quarter end statements and then move on, which is what it feels like they're trying to do. But hold on. Next up was the chaos and the havoc created in the UK on Tuesday, September 27th, when Prime Minister Truss and her Chancellor of the Exchequer proposed big tax cuts, which were unpaid for on the wealthy, right? And that sent the credit and the currency markets down the drain. UK bond yield surged in value. The IMF, the International Monetary Fund, warning that the UK not to do it. Moody's and S&P threatening to cut the country's credit rating, and this caused the Bank of England to have to pivot announced that they would be buying the longer-term bonds to try to calm the markets. But that only created more unrest as global investors tried to figure it out in what others are calling, or were calling, a financial crisis across the UK. And to add fuel to the fire, it was rumored that Credit Suisse First Boston was about to circle the drain, which caused all kinds of speculation around a host of other European banks in what was being described as another Lehman moment. And then the bell rang and the month and the quarter were officially over. They were bruised and battered, but it was done. And then enter stage left, the fourth quarter, right? The new quarter, which started on Monday. And on Monday, after that anxiety-filled weekend, we learned that Credit Suisse was working the phones all weekend, promising the world that they had more than enough capital to weather the storm as they launched a restructuring that is set to be announced at the month end. So expect all kinds of job losses there and pivots and all that stuff. And then we had the UK government pivot on the tax thing as Prime Minister Truss's own party appeared to turn on her. After only 3 weeks on the job, word is that she's already a lame duck. But that's another story. Then we had the Reserve Bank of Australia raise rates by only 25 basis points after they were expected to raise by 50. And that caused all kinds of speculation. And oh my God, the Fed was going to pivot. I mean, if the Reserve Bank of Australia pivoted, that must mean the Fed must pivot as well, which doesn't really make a lot of sense to me, but that's a whole nother conversation. And then that caused all those shorts, right, remember them, to start to run for cover and reverse the bet, going from seller to buyer, and don't discount how the algos reacted. Suddenly, all of the indiscriminate selling that they did during the month of September turned into indiscriminate buying during the first 2 days of October, and that helped to send the markets on a tear, rising more than 6% in only 2 days, and this caused many of the talking heads to call the bottom, telling us that this was the start of something big, to which I would say, hold on, boys, not so fast. The speculation that the Fed will pivot in November is just that. It is speculation. It is the street trying to force or bully that decision on the Fed, which I'm betting not going to work. Inflation is still running at 40-year highs with little signs of it abating. And so, no, I don't see how they can change course right now. Then we have the coming earnings season, which is expected to be a bit of a disappointment. Just how big is yet to be determined. I told you yesterday that FactSet has taken third quarter S&P earnings growth down to 2% year over year from the 9% they had in early July. And that also added pressure to stocks at the end of September. Some now saying that investors have already discounted that revision, so a weak quarter may already be priced in. So if we have a weak quarter, that it may be bullish. I'm not so sure I'm buying that just yet. Depends what inflation does. The strong dollar is also an issue for the big multinationals that have not come clean yet on how that's going to impact their earnings. So that's also a headwind. And then we got the next FOMC meeting in 3 weeks, followed by the midterm elections, which are expected to be anything but smooth. So I suspect that this month we're going to have its share of uncertainty and volatility, which goes back to my August commentary that we are entering the danger zone. September and October tend to be seasonally weak times of the year. Besides, I tend to be a bit suspicious of October anyway, right? Think 1929, 1987, 1999, 2000, 2005, 8, 18, 19, 21, and now October of 22. Once again, every sector, though, yesterday was in the green. Energy rising once again, taking the lead up 4.5% as the world waits for that OPEC decision today, right? That potential production cut of 1 million barrels per day. Yesterday, West Texas Intermediate kissed $87 a barrel before backing off. This morning it's trading down 55 cents at 85.97. The White House working overtime to try to convince them to maintain production, threatening that a cut will hurt U.S.-Saudi relations. Okay. Industrials, consumer discretionary, basic materials, financials, all up more than 3.5%. The other 6 sectors were up between 1.5% to 3%. Disruptive tech, ARKK up 7.6%, leaving that group still down 55% year to date. The value trade up 3%, SPYV. The growth trade, SPYG, also up 3%. Semiconductors up nearly 5%. Artificial intelligence up 5%. And as you would expect, the contra trades are all a bit lower. Although today, we may see that reverse. The dollar index trading at 110.79 this morning. It's now down 4% since last week, and that's also helping the overall move. Further declines could see it test support at 108.80. Gold, which has rallied nicely over the past week, is taking back some of the move as the trader types take profits after we kissed resistance at 1736, a level I told you to watch on Tuesday. And this morning it's down $10, trading at $1,720. This morning, U.S. futures are pointing lower. Dow futures down 275, S&P down 36, the NASDAQ down 125, and the Russell down 23. Actually, Dow futures are down 346 now. Eco data today includes mortgage apps, S&P Global Services PMI, and ISM Services PMI, both measuring the same data point and both with different results. The S&P is expected to report a reading of 49.2, which is contractionary. The ISM is expected a reading of 56, which is expansionary. And then we have the ADP employment report, and that's expected to show an increase of 200,000 jobs. But the real data point will be Friday's non-farm payroll report, and that too is expected to show an increase of 260,000 jobs. So the issue is, will those reports be stronger or weaker than the expectation? The market wants weaker numbers because that would support the idea of a Fed pivot, which I still don't think is happening in November. While stronger numbers would support the idea of continued aggressive rate hikes. European stocks are all lower across the board. They're down between about 1%, 1.5%. Eurozone PMI dropped to a 20-month low. 48.1, that's in contraction territory. And that is now sealing the likelihood of a recession across the 19-member common currency bloc. And that is taking the shine off their recent rally after last week's kind of chaos out of the UK. The S&P closed at 3790 last night, up 112 points after trading as low as 3726 and as high as 3791. If futures back off as indicated in early trading, I suspect that we might try to go back and fill the gap at 3,700 that we created yesterday. Right now, it appears that we're in the 35.85, 39.60 trading range. It's important that the S&P hold the low created at the end of September as we move into the earnings season, and that's the 35.85 number. If it does, then that would be a positive signal. If it fails to hold that low, then brace yourself for even lower lows in that lower high, lower low pattern I described yesterday. Look, we're now in the final months of 2022. Portfolio managers are certainly going to go shopping for names that have been completely dislocated and beaten up, as you should as well. And while I think this rally is going to stall once earnings starts, the midterms will only add another level of uncertainty. Remember, the Fed has the next meeting on November 1st and 2nd, and the elections are the week after. In any event, I do expect a Christmas rally post the election. That'll take us back to around 4,000. 2023 expectations, will be modified once we get through the election and it becomes clear what the outcome is. In the end, like I tell you, if you're a long-term investor, it is always best to stick to your plan. There is no need to think you are missing out. If you're invested in strong, well-diversified portfolio, you will be participating both ways, but on the way up, you'll be participating. And you'll be getting paid for being invested, right? Think divvies. Be strategic when allocating new money to your long-term portfolio. Right now, in this anxious time, overweight the big, boring names that are good divvy payers, right? While we are in this storm. Okay, so what do we have for dinner tonight? So there was this great restaurant that was around the corner from where we lived that my parents used to go to. It was always one of those restaurants you could always go to, never be disappointed. You knew everybody. The waitresses knew you. They knew what you liked to drink. They knew what you liked to eat. It was simple, right? It was called Fantasia's. And it was located in Cambridge, Massachusetts, where I grew up in Belmont, Massachusetts, so it was just the next town over. And like I said, my parents used to frequent that a lot with their friends, and occasionally they'd take us when we were little. And like I said, it was one of those places that you could always count on no matter what. And everyone was always so welcome. When you went there, you felt like you were almost home. So for this, you need 10 large shrimp, right? Jumbo shrimp. You need a small can of evaporated milk, 1 egg, lightly beaten, butter, 2 cloves of garlic, mince, 4 tablespoons of lemon juice, salt and pepper to taste, a 1/4 cup of flour for dredging, and 3 tablespoons of chopped parsley just for garnish. You want to clean and rinse your shrimp, and then pat them dry with the paper towel, and then dredge them in the flour, set them aside. Now you're going to make the egg wash, right? You want to beat the egg with the evaporated milk. Mix it together and then beat it. Dip the flour-coated shrimp in the egg wash. Let the excess drop off and then dredge them again in the flour. Heat the butter in a large saute pan, right? So you want to put some butter in a large saute pan, heat it up. Add the garlic. Once it's all nice and hot, now you're going to add the shrimp. Saute the shrimp on both sides until they're golden brown. Right? Shrimp don't take a long time to cook, so be careful, right? You want them to turn kind of pink and don't overcook them because then they'll get tough. When the shrimp are cooked, now take the fresh lemon juice and squeeze it over the top. Season it with salt and pepper just to taste. Remove the shrimp from the saute pan and then place it on a platter. Pour the melted garlic butter over the shrimp and then garnish it with the parsley and serve it that way. Now look, you can take that, you can boil up a pound of linguine. You can make shrimp, linguine and shrimp scampi. You can just have the shrimp scampi alone. If you do that, make sure you have some garlic bread, because garlic bread is always great with just the shrimp scampi. You would drink a white wine with this, not a red wine. And you know me, my favorite, Pinot Grigio Santa Margherita, is what works really well with this dish. I'm not a Chardonnay person, so I'm not giving you a Chardonnay just because I don't like Chardonnay. But I'm not steering you along because Pinot Grigio is great. And look, crude oil is now up $1 at 87.41, up 1%, just over 1%. So we'll see how that works out. In any event, until tomorrow, take good care.